Hello. Welcome to our next chapter, that is IND AS 12 of income taxes. This is a little complicated chapter, but I've tried to make it as simple as possible. So this entire chapter is based on the concept of deferred tax. So if entire chapter revolves around your DTA and DTL, that is your deferred tax asset and deferred tax liability. So if tax that is unpaid, if there is tax which is unpaid, it leads to your DTL, that is your deferred tax liability. And if there is any tax paid in excess, that leads to deferred tax asset. And you will recognize DTA or DTL only and only if this is a temporary difference. Only and only if this is a temporary difference will you be recording. Any permanent difference will not be recorded as DTA or DTL. So why we record this as DTA detail? Because we say कि right now we have paid excess tax or right now we have paid less tax, but over the years this will be compensated. That means if we have paid more tax right now, in the future years we will be paying lesser amount of tax. Therefore, we created deferred tax right now so that this will be set off against future years. So your steps for deferred tax, first of all, first step is compute the carrying value of the asset or liability. Now, what is carrying value? Carrying value of the balance of asset or liability as per the accounting records. As per the accounting record, what is the balance of asset or liability? That means your book value. Second is the tax base. So compute the tax base. We will be comparing both of these. That is your carrying amount and tax base later. Okay, so you have to compute tax base. Now, what is tax base? So for assets, your tax base is the amount that will be deductible for tax purpose in future periods. The amount that will be deductible in future periods. Okay, so for assets, it is amount that is deductible, and for liability, it is the carrying amount minus the amount deductible for tax purpose in future. So say asset and liability are reversed. So asset is amount that will be deductible for tax purpose in future period, and liability is the carrying amount minus the amount deductible for tax purpose in future. Important point to notice for revenue received in advance. If you have received any revenue in advance, that means you've not provided the service, but you received the revenue. In such a case, it will be the carrying amount minus amount not taxable in future. Okay. If any asset is not taxable or if the liability is not tax deductible, then in such a case, tax base will be your carrying amount. Your tax base will be a carrying amount, and therefore, when you see in step 3, your amount temporary difference will come to zero. Therefore, if your asset or liability is non-tax deductible, in such a case, your temporary difference becomes zero, and there is no concept of DTA, DTL, because if there is no tax, then there is no tax liability or tax asset. Third is your compute temporary difference. Compute temporary difference is carrying amount of asset or liability minus tax rate. That is your step 1 minus your step 2. Now coming to your step 4 is classification of temporary differences. That means how do you classify these temporary difference? So if what you do in step 3, that is your 1 minus 2, that is your carrying value minus your tax base. If that comes positive, if that comes positive for an asset, it is a direct tax liability. If it comes negative, it is a direct tax asset. So you just have to learn one of them, and this is all opposite. So for liability, the same thing, but opposite. And so for liability, if your step 3 is positive, it is a direct tax, deferred tax asset. And if it is negative, it is a deferred tax liability. Next is assess deferred tax assets. So a deferred tax reduces future taxable profits because right now you have paid excess tax, which means that in the future years you will be paying lesser tax. So the order of utilization of DTA is as follows. So first of all, you have to net off against deferred tax liabilities. The small thing is if it is the same tax authority, that means if it is the state government in both the cases. So you have to net off first against deferred tax liability. If you still have anything left, recognize to the extent of probable future taxable profit. That means this is the amount that you will be able to utilize. Say for example, if you have paid extra tax right now of say example 100 rupees, but over the future years, your taxable profit come only to 70 rupees. So in such a case, there is no point of recognizing 100 rupees as deferred tax asset because you will be able to utilize only 70 rupees. So in such a case, this will be set off. And last is check for any tax planning opportunities, whether there are any possible ways to use this extra left 30 rupees. Next is your tax rate applicable. So the expected rate for period when DTA will be realized or DTL will be settled. So you have to use the tax rate, not current, but the expected tax rate for the period when the DTA, that is your deferred tax asset, will be realized. That means when it will be utilized or when DTL will be settled. The DTA or DTL from revaluation of non-depreciable asset. If there is a non-depreciable asset, what is an example of a non-depreciable asset? That is your land. So if there is any DTA or DTL from revaluation of non-depreciation asset, tax rate applicable to the recovery of carrying amount through sale should be used. So what tax rate will be used? You will use the tax rate which is applicable on recovery of carrying amount through the sale. That is when you sell, what amount you will receive, what tax you will be paying on that. And last is accounting of deferred tax. Accounting of deferred tax. So if the item pertains to P&L, if your item pertains to P&L, that is say for example depreciation, you will recognize the direct tax. Uh, you will recognize the deferred tax in P&L, whichever it is, asset or liability. If the item pertains to OCI, that is say for example revaluation profit, in such a case, you will recognize the deferred tax in OCI. And last is your deferred tax arising on business combination. Any deferred tax that arises on business combination will be adjusted against goodwill. Okay. Now there are certain points that you can cover. So I have mentioned them over here. So there are some exceptions with regards to business combination, asset acquisition, SBP, that is your share-based payments, investment in subsidiary, associate, JV. So these are some of the topics that have not been covered in the notes because they are too lengthy and possibility that may or may not come. So it is as per your discretion to study these topics from whichever faculty you've taken your books from. And with this, we are done with this IND AS, that is IND AS 12.